You ever watched Jerome Powell on TV? Suit sharp, language sterile, and thought, finally, the Fed held rates. Maybe I'll catch a break. And then you go check your loan offer or swipe your credit card and nothing changed. Your credit card's still at 27.9%, your mortgage rate didn't budge, and your bank still ghosting you on that expansion loan. So what gives? Here's the truth. The Fed doesn't control your rate you actually pay. The banks do. And right now, they're padding profits, hoarding capital, and keeping rates high, no matter what Powell says. Welcome to the Heartbeat of Money. I'm your host, Jon P. Moffitt, and today we're going to unpack this. Because what's happening behind the scenes in banking and monetary policy is driving the rates that affect your business, your debt, and your life. So let's talk about it. The federal funds rate. That's the tool Powell's committee adjusts. It's not your mortgage rate. It's not your business loan rate, and it's definitely not the APR on your credit card. The federal fund rate is the interest rates that banks charge each other to borrow money overnight. Let me explain why this happens. Banks are required by law to maintain a certain reserve ratio. That means they have to keep a percentage of their deposits in reserve so they don't lend out every last dollar and create a liquidity for the bank. But banking is fluid. One bank might have too much cash sitting idle, and another might fall short after processing loans, paying payroll, and unexpected withdrawals. So every night, banks lend and borrow from one another to balance those reserves. This is where the federal funds rate comes in. It's the benchmark that guides how much they should charge one another for that overnight cash. Now, why should you care? Because this base rate becomes the foundation for everything else in the credit markets. It influences short-term Treasury yields, prime rates, and banking lending standards. But it's just the floor. Your interest rate, that's several layers above it. So let me give you an example of like a layered cake, a real-world rates and how they're built. Layer 1, the Fed funds rate. That's the base layer. Layer 2, Treasury yields, SOFR, or secured overnight financing rate, and then market forecasting. That's reflecting inflation, expectations, and geopolitical risk. Layer 3, that's your risk profile, your credit, your cash flow, business type, and the collateral. And then layer 4, that's the margins, the profit cushion, reserve risk, and competition or lack thereof. So even if Powell freezes or cuts the base rate, banks can still charge 9% or more because they're adding layers that protect their margins and hedge their risk. I had a borrow recently. It was from a restaurant group. He was an owner. He came to me, profitable business, clean records, and good credit. He was looking for a $400,000 to launch his second location. And despite everything in his favor, the bank quoted him at 10.25%. That's after the Feds said that they were holding steady. Why? Because the bank wasn't lending off the Fed's rate. They were pricing off real cost of capital, their risk buffer, and what they could earn elsewhere. Which brings us to the next real kicker. Right now, many banks would rather not lend to you, not because you're unqualified, because it's more profitable and safer for them to park their cash elsewhere. Let me explain. Banks have a simple decision to make every day. Do I lend money to businesses at 9.5% with risk, paperwork, and regulatory compliance? Or do I buy a 2-year Treasury at 4.8%, guaranteed zero risk, instant yield? Most of them are choosing option B. And the decision is happening on a $1 trillion scale. When banks buy Treasury instead of making loans, several things happen. 1, credit gets tighter. Less lending capital means stickier underwriting, lower approvals, and fewer funding options for businesses. Rates stay sticky. Because they don't need to compete for borrowers, banks don't lower their lending rates. Even if the Fed cuts, there's no incentive. And then long-term interest rates rise or stay elevated. Heavy demand on mid or long-term Treasury should push yields down. But because of inflation uncertainty and global repositioning, the yields have stayed kind of elevated. So right now, we're in a moment where banks are saying, why take a loan when I can lock in a safer rate at 5% with Treasuries? That's why your mortgage rate is still at 7%. That's why your line of credit hasn't improved. That's why funding feels tight, even though Powell hasn't hiked in months. So let's talk mortgages for a second. The 10-year Treasury is around 4.3%, but mortgage rate's still at 7%. Why? Because mortgage lenders build a spread on top of the Treasury yield. They factor in credit risk, repayment risk, or prepayment risk, and cost of servicing the loan. So even if the Fed holds or cuts rates, you don't automatically get a discount. The bond market, banking strategy, and risk management all play a much bigger role in that rate. So this is more than theory. This is about you, a business owner, an entrepreneur, a homeowner. You're living in the world where the Fed is signaling caution and banks, they're holding liquidity. And every day, borrowers paying the price. It's not just the rates that are high, it's that access is scarce. And that's why you don't get an offer. And if you do, it's expensive. So let me give you a path forward because there is one. Step 1, clean up your financials. Get your P&L, balance sheet, and taxes in order. Banks hate uncertainty. Next, tell a capital story. Don't just apply, present. Why now? What's the upside? What's your risk mitigations to your business or what you're doing? And then become the prize. You want banks to compete for you, not the other way around. That comes from prep, clarity, and leverage. And then shop wide. Don't just walk into your local bank. Use a platform that accesses multiple lenders, like the one I have, ComLoan. Let lenders compete for you. And don't wait for Powell. Prepare for the bank. I've placed over $1 billion in capital, and I'll tell you straight. 2 borrowers can walk into with identical revenue, and one gets 7.5% and the other gets 9.9%. It's nothing to do with the Fed. It has everything to do with preparation, story, and timing. So don't wait on Powell to bless you with a lower rate. Get your house in order. Play the game the banks are actually playing and make yourself irresistible for capital. Because here's the thing, the heartbeat of money, we don't hope, we prepare. So if this hit home, if you're tired of playing a rigged rate game where rules keep shifting, then take action. You can visit me at Jon Moffitt at comloan.com, and you'll find tools, education, funding access that can help you beat the banks at their own game. And if you loved today's episode, share it, tag it with somebody, and subscribe. I'm Jon Moffitt at the Heartbeat of Money, and I'll see you next time.